Hola, Econ peeps. Time for another module. This one is module 12. We're going to talk about money and banking today. We can't really talk about monetary policy without talking about money and banking. So we kind of have to introduce, to get to monetary policy, we have to go through how we define money and what our banking system is used for. So that is what is on the itinerary for the day. You have 7 practice questions. So that'll be popping up as you work through this video. All right, let me get my big head out of the way. All right. So first question, what is money? Well, for a long time, we did not have a real system to conduct transactions. And so we would barter. And barter is quite literally just trading one good or service for another. No money involved. The problem with a barter system is it requires what economists call a double coincidence of wants. Meaning it's not enough for somebody to have something you want. You have to have something they want to be willing to trade. Okay? And the idea that you would just happen to stumble across somebody who both has something you want and wants something you have, it made transaction incredibly inefficient. Okay, so a barter system is not preferable to what we do, generally speaking, today. So, and obviously, as I said, it's a lot more inefficient. Okay, there's different kinds of money. We're going to talk about 2 different kinds. So there's 2 different kinds of money: commodity money and fiat money. We will talk about each of those. And money has 3 different functions that we're going to talk about as well. So the first kind of money, commodity money, is any item that's used as money but has some value from its use as something other than money, right? Gold. Gold has intrinsic value. For a long time, we used gold to back our currency. It's called the gold standard. I'm sure you've heard of this, probably, many of you, some of you. Your father, grandfather, grandparents, parents, somebody probably has said something. If not, you can ask them about it. They know anything about the gold standard. But for a long time, our currency was backed by the gold standard, meaning that it was the value of the currency was pegged to the value of gold. And that's what commodity money is. It's money that is effectively pegged to some kind of commodity. It doesn't have to be gold, but it historically has been. Okay, and that's really commodity-backed currencies. Okay, and then there's fiat money, which is something that's used as money, but which in and of itself has no intrinsic value. The money right now we use fiat currency, and the problem with fiat money is that it has no real intrinsic value. That dollar bill, $10 bill, $100 bill, that C note is worth little more than the paper it's printed on and the ink that was used to print on it. That's all the real value there is there. It only has more value to us because we say it does, not because the currency itself has that value. It's relatively worthless, but we use it to transact business, so it has value because we say it so. But it has no intrinsic value outside of our use. Okay, and then the 3 different the 3 different functions of money. One of them is, the primary one, is a medium of exchange, right? It's, as I said, the reason why our fiat currency has any real value at all is because we use it to transact businesses. In the absence of that has no value. The same can't be said of gold or some other kind of commodity-backed currency or commodity money, right? I mean, even if you don't take it anymore as a medium of exchange, it still has value, right? There's still people buying gold all the time. Right? So, it's different from fiat. And a medium of exchange is the primary function that our money serves. It's so that we can transact business. It's a method of payment, all right? So, that's the primary function. The other one is a store of value, right? The second one should say money serves as a store of value. In other words, my house is worth $300,000 or whatever. My car is worth $25,000, $30,000 or whatever. Right? It holds value, and certain assets appreciate, some assets depreciate. Right? And so that matters as far as a store value. And then it also serves as a unit of account, a way of kind of comparing and measuring the value of something, right? So oil, for example, is priced in U.S. dollars, and that's an example of money being used as a unit of account. Okay? All right, commodity versus fiat money. Again, money, we've had all kinds of different money in different cultures around the world. Commodity money can be any commodity. Gold is the obvious one, but it can also be silver. Cigarettes in prison, right? Commissary access. Cocoa beans. Whatever is in demand there, you can certainly trade and use as a form of commodity money. And then again, fiat money just has no intrinsic value. It only has value. It says because a government says it's a legal tender, but honestly, it doesn't matter what the government says. If we don't want to take the money, it's no good to us. The fact that we value it in our business transactions and the transactions the average person conducts, that's why this money has value. Okay? Not otherwise, in the absence of us willing to transact business with that money, it's worthless. All right, some more definitions. Two different ways we measure money, M1 and M2. We'll talk about each of those. All right. Obviously, the coins and currency in circulation is just reference to the coins and bills that circulate in the economy, right? This is money that's not held by the Treasury or the Fed, or in bank vaults for that matter. It's not deposited anywhere. It's in our pockets. It's in our change jars. It's in the cushion of the living room sofa. That money in your purse, wherever it might be. Credit cards. Hopefully, we all know what credit cards are. It basically is a way of having access to funds that you have to pay back plus interest. It's a card that basically lets you borrow money in the immediate for immediate use and then pay it back with interest. I have several credit cards, and I typically try to keep them paid off every single payday, and that way I don't have to pay any interest. Usually the interest accrues on a monthly basis, so if over the course of a month I put $100 on a credit card or something, pay off that $100, I don't owe anything, I don't owe any interest. So credit cards can be useful, but they can also be, you got to be careful, got to be responsible. Historically, I've not been, but I managed to build it back up and do okay. Debit cards, this was a magnificent invention, let's be honest. This was not always the case. We didn't have debit cards until the internet came around. And I remember in early 2000s, I got a bank account with one of the first online banks. It was called NetBank. It may have been the first. I don't know. But this was 2001, 2002, something like that. And I got a bank account with them. I used that for direct deposit, which was just now coming out. It used to be you had to go pick up your check, or they would mail it to you. But then slowly but surely we started doing direct deposits when the internet happened. And with this bank, I got a card. I just love that because there were some places, you don't want to carry around cash if you can help it usually. I was living in Austin at the time. And so that card came in really handy. Love debit cards. All right. It's just a plastic check. You don't have to write on it. You don't have to do anything with it. You put it in, get your money, go pay, whatever. It's a really useful thing. A demand deposit are those checkable deposits. That's the money that you're usually accessing with your debit card, or you could access writing a check. Most of you, I'm guessing, have never wrote a check. You may have never even seen a check. But checkable deposit is the money you put in a bank that you can immediately access for withdrawal. Okay? Liquidity is a reference to how fast an asset can be converted to money, right? And then the M1 money supply is a narrower definition. And it includes currency, checking accounts in banks, and something called traveler's checks. Again, with the advent of debit cards, traveler's checks have really fallen out of style. You may have had them. When I was in high school, and my mom had remarried, the guy she remarried was a little bit better off than we ever been, enough to where they could save some money and take us on vacations when I was a teenager. And that's just what you want to do when you're a teenager, right? Go to Chattanooga, Tennessee with mom and dad. But anyway, off we went. And they would do traveler's checks. It was basically a way, it was just represented cash, but if you didn't sign it, it didn't have any value. So it was a way of protecting. You lost your wallet with the cash in it, it was gone. You lost your wallet with a bunch of traveler's checks in them, you could have traveler's checks replaced. All right? Because nobody can cash them if they're not signed. If they're not signed by you, if there's not, there has to be kind of a matching thing that occurs. So M1 money supply. Traveler's checks really aren't a thing anymore, I don't think. But currency, checking accounts, and banks. M2. M2 is a broader definition, includes everything in M1. M1 is part of M2, but it adds savings deposits, money market funds, CDs, certificates of deposits. All right, so what are those? Money market funds are deposits many investors are pulled together and invested in a safe way, like short-term government bonds. Typically, a money market fund is going to be more than just one thing, like a short-term government bond. It may be some stocks, some bonds, some of this, some of that. A diverse portfolio. That's my understanding of a money market fund. A savings deposit. Hopefully, most of us know what that is. That's a bank. That's a type of account where it's not as easy to withdraw money by writing a check. Usually your debit card's not going to work on your savings account. You can withdraw it. We frequently move money from our checking to our savings and sometimes back if we get a little short at the end of the month, right? But we do try to keep some in savings. It's gotten down to, well, we've had as little as zero, but we've also had as much as several $1,000s in a, $5,000-$10,000 in our savings account at one time, and we slowly build it back up. Something happens, need new tires, whatever. We use that and move along, right? So as you get older, you're going to definitely want to take advantage of these things to the extent possible. Okay, a smart card, something the authors of these PowerPoint slides made up. I guess it's like a secure credit card, or really more like a debit. You put money on it and you can pay, like a gift card almost. And then a time deposit, right? A time deposit is says that you put the money in the account, but you're not allowed to use it for a period of time. And if you do, if they do allow you to take it, it's usually going to have some sort of a punishment. You're not going to be able to get it all. You can only if you're going to have to pull it out early, you're going to take a loss. So to discourage you from doing that, to create a disincentive for you to take your money out. The whole point in this time deposit is for it to be there a while. Okay, you typically get a higher rate of interest. And another name for these time deposits, that's what a CD is, certificate of deposit. All right, so here's M1 and M2. M1 is that narrow definition, just the coins and currency and your checking account. That's pretty much it. Traveler's checks, bleh. Right? And then the broader definition includes everything else: savings, money market funds, CDs, etc. Okay? And remember, M2 includes M1. Here's a Venn diagram. If you've ever seen this, you know what this is. The broader one is M2, and you'll notice M1 is inside M2. There is 100% overlap. Everything that's in M1 is also counted in M2. Okay? All right. Hopefully we know what credit is, right? Anytime you make a purchase that when you're using money that you don't have, that's usually credit, right? All right. You use credit to buy cars, a house, college expenses, right? Big ticket items that you're hoping to get enough of a return on that. You've now got you're now liable for that money to pay back, and you're pardon the pun, you're banking on getting a greater return from it. If you take money out to get a college degree, you're hoping that college degree will enable you to make enough money to pay back those loans and then some. Harder and harder to do these days, isn't it? All right. So that's credit. All right. I think we all get what credit is. All right. Financial markets. So they're making some distinctions here that I'm okay with, but typically we talk about bonds as short and long term. Not bonds are long terms, bills are short terms. I've not ever heard this put that way. That's how infrequently we use it interchangeably. And so bonds these are debt instruments, not debt, right? It's basically an IOU. Bonds are an IOU. They can be issued by the federal government, by the state government. They can be issued by metropolitan areas, Tarrant County College passed a bond. School districts passed bonds. Um, corporations can issue bonds. That's how Jerry Jones paid for Jones Mahal. And I'm going to go see the Cowboys on the 30th with my son. Yay. I'm hoping. We will see. But that looks good. I got the tickets. I'm way up, but they've got a big giant screen, so they tell me it'll be all right. So anyway, excited about that. But yeah, these bonds are debt instruments. This is basically an IOU. You go and buy it from them, pay for it bond. It's an investment. And the bond typically has two components that you want to know about. It has a maturation date, which tells you how long it takes, right? Now, they're saying bonds are typically 10 years or more, and bills are less. Yeah, there's 2 year. I'm almost certain there are 2-year bonds. In fact, I know there are. So it's not really long-term debt instruments. But the longer the term, the greater the return. These are very low-risk investments. The government you're virtually guaranteed to get your money back. They're very popular, but there's not a great return, right? There's an inverse relationship between the risk and the return. And with these being such low risk, there's very little return. But again, if you're looking for a safe place to put your money, make a little bit on it, and it's long-term, especially the longer you put it in there, the more you're going to make on it. Then if nothing else, it's at least going to avoid the erosion of purchasing power that inflation causes. Typically, those bonds are going to at least be a safe place to put money so that you don't lose purchasing power to inflation. Okay? And so, like I said, IOU, maturation date, how long it's good for. The second part of it is its yield rate. What is that rate of interest on those? Okay? So those are two things you want to look at when you're looking at bonds. Stocks, right? This is ownership of a private company, right? If you buy a stock in a company, you own some piece of that company. The IPO, or initial public offering, this is the first time that a company will sell stock. This is their initial stock offering, right? And securities are typically just a broad term that captures much of the financial assets that are out there, generally referred to as securities, financial assets. All right, so it's important to understand. There's one of the biggest things I hear is all these wealthy people are hoarding their money. That's nonsense. Unless they're putting it under their mattress or storing it in mason jars in their backyard, that's not really something that anybody with a brain's going to do, because again, inflation is going to erode the purchasing power. You put $10,000 under your mattress 10 years from now, you don't have $10,000 anymore. You've got, because it's not going to buy $10,000 worth of stuff like it did. So you've lost money in that particular deal. So people don't hoard money. That's just not true. Now, they put it in banks. They put it in investments that will ensure that they don't lose their value of their money over time to inflation. Well, that money is what's used to loan businesses. That's the money you use to buy your car. Your parents used to buy their cars, buy their houses. All right. So it's just not. It's part of this unproductive conversation we have about around this kind of stuff. There's none of that. Now, it is fair to point out, though, that the marginal use of this money, right? That because people at the lower end of the socioeconomic scale, they'll spend more of their money because they're at that end, versus the people who are wealthy, they have it to kind of sock away in an interest-bearing account somewhere. That's useful, but it's not as good as just being outright spent necessarily. That's a fair point, that poor people will tend to spend more than wealthy people, proportionate to their income, relative to the size, to how much money they have to spend, right? But that's not to nobody with a basic understanding of math and economics would ever suggest that means that we shouldn't have any wealthy people. There's a lot of folks out there who believe that we should cap incomes at $1 million or something like that. That's obscene and idiotic. Sorry, it just is. If you do, you're not going to accomplish anything other than preventing people from creating wealth. How is that a good thing? That makes no sense to me. Wealth doesn't exist if nobody makes it, and nobody's going to make it if you're just going to take it away from them when they do. That doesn't make any sense. It's not like this money sitting out in a pile out in the desert somewhere, and they just beat you to it because they had a faster car. That's not how this works. That wealth was only made manifest because they made it manifest. It didn't exist otherwise. And take away their incentive to create it, which is, hey, I get to keep it, at least some of it, most of it even, then there's less incentive to make it. And all you've done now is prevented your economy from ever growing much at all, because there's no longer any money to loan out. Not near as much anyway. So there's my spiel. So your financial markets are include banks, equity markets like the stock exchange, NASDAQ, bond markets, commodity markets where you buy gold and silver and all that stuff. Financial markets are global. Americans, we invest in foreign markets just like foreign consumers invest in ours, right? So you can buy foreign stock, and foreign entities can buy domestic stocks, right? All known as securities. All right, interest rates is the price of borrowing in the financial market, a rate of return on an investment, right? There's really another way you can think of interest rates. Interest rates are also the opportunity cost of current consumption, right? Because in our economy, we do one of two things with our money. We spend our money or we save our money. Higher rates of interest create an incentive for us to save our money, right? So the opportunity cost of current consumption, interest rates act as the opportunity cost of current consumption, because if we spend our money, we're not saving it. And interest rates can create an incentive to save. So when they raise interest rates, one of the things that happens is not only does it make borrowing money more expensive, right, because it's the price of borrowing money, but it also incentivizes consumers to save money. And if they're saving money, they ain't spending money. And if consumers don't spend, the economy doesn't do as well. All right. Intertemporal decision making. Give me a break. Listen, I can pronounce intertemporal. It's nonsense. It's just silly. It's frou-frou. It's kind of a little fad thing that's going on in economics, and I'm not impressed with that kind of stuff at all. It's not necessary. It's just not necessary. All right. Commercial banking system, checking accounts. We know what that is. That's the bank account that typically doesn't have any kind of interest. If it does, it's very little, but it gives you easy access to money. It's a place to hold your money so that people don't just assume that it's in your car or in your house and rob you all the time, right? Credit union, nonprofit financial institution, debit cards, we've talked about that. Depository institution is any institution that allows you to deposit money. And they use that money to make loans. We're going to talk about that in a moment. And a financial intermediary is an institution that is between a saver with financial assets to invest and an entity who will borrow those assets. That's a little convoluted. You know what a financial intermediary? It's anybody between buyers, consumers, and producers. That's what that is, right? It can be, you can be, wanting to consume anything, consume financial assets. I don't care. But a financial intermediary is that third party that bridges the gap between supply and demand. Really, it enables transactions. So in a safer way, it guarantees that the money's there. All right. The role of the bank, again, we put money in our banks to save it. They then take that money and they lend it to borrowers who pay it back with interest. And that's how that's the money the banks use to pay out interest on the money that we deposited there. And there's the cycle, right? All right. An asset is an item of value that a firm or an individual owns. Liability time mismatch, again, is just some economic frou-frou nonsense. Balance sheet is an accounting tool that lists assets and liabilities. Oftentimes it's going to be called a T account, I think is what they want to call it, because it looks like a giant T. They put a line across and one down. Assets over here, liabilities over here, and they have to equal. They have to balance. All right. Bank capital is also another way of describing the net worth of the bank. Diversify means that you don't want to just invest in a single thing. You don't want all Microsoft stock or all Apple stock. You might want some tech stock, and you don't even want all tech stock. You want tech stock, healthcare stock. You want some bonds, some government bonds, maybe a local municipality bond. You want a mixture, a wide array of assets, so that if any one of them takes a hit, usually the whole economy is not going to be suffering like it is now, but that happens too. But there are certainly transitory things that happen in different areas. Healthcare might take a hit, like during COVID or something, or it may be that was a better investment during COVID. I don't know. So tech stock may take a hit, and there's some seasonality and some ebb and flow as things change and as the markets move, and track that stuff. And maybe you want to keep a variety of things, so that if any one of them falters, it doesn't take the whole value of your retirement account or whatever kind of account you have down. All right, and that's just known as diversification. There's a way, if you ever take a finance class, you'll take a class where they'll teach you how to calculate the beta coefficient, which is basically a measure of how diversified your portfolio is. A liability is any amount or debt that a firm or an individual owes. So an asset is an item of value. Liability is an amount that's owed. Okay? And those are the two things that appear on your T account, on your balance sheet. Net worth is the excess. That's basically your assets minus liabilities. If that's positive, then that's what wealth is, really. Right? Wealth isn't simply how much money you have. Wealth is the value of all of your assets, which would include money, minus all of the liabilities you have. Reserves. This is a really important idea. We operate what's known as a fractional reserve banking system. Right? A fractional reserve banking system is one in which banks are required to keep some fraction of every dollar deposited in their bank. They cannot loan everything out. And so the Fed sets the reserve requirement within certain statutory limitations defined by Congress years ago. But this basically really came about after in the Great Depression, when there were runs on banks and the banks didn't have the money to give to people. They lost all their money and banks went down. So now we have FDIC, which government insures your deposits, and we have a limitation. Banks cannot loan they can't empty their vault. They have to maintain some reserves every single day. They have to report it to the Fed and let them know they've met their reserve requirement. Okay? All right, so here's a T account. This is what I was talking about. Assets on one side, liabilities on the other. Here's their loans. Here's their deposits. And you'll notice that 5 plus 4 plus 2 is 11. 10 plus 1 is 11. It's in balance, right? That's what we want. Okay? All right. This says that banks create money by making loans. No, they don't. The money was already created. It's just a weird thing, and all the textbooks say the same thing. Banks create money by loans. No, they don't. The money already existed. It had already been created. All they're doing is putting it in the money supply. They expand the supply of money using loans. And here's how that works, okay? Let me get a blank piece of paper just real quick and show you something. So I suspect in a future lecture they're going to talk about this. But remember I told you there were three money multipliers? Or three multipliers, right? There was the fiscal multiplier or the spending multiplier. There was the tax multiplier. I think we talked at least briefly about both of those in the last lecture. Well, there's also a money multiplier, right? And the money multiplier is 1 over my reserve requirement. Just that simple. 1 over the reserve requirement. So here's how this works. So let's say that you deposit $1,000 in Bank A, and the reserve requirement is 20%. So Bank A is going to have to keep $200 in the bank. They can loan out the other $800. Somebody comes along, borrows $800. They go then and put that $800 in their bank. Guess what? That bank can loan out $640 of that dollars because they have to keep 20% or $160 of that $800 in the bank. But the other $640 goes back out, and that process keeps getting repeated. So even though only 1,000 initially got deposited, it goes out 800, then 640, and then 80% of that's going to go out, and 80% of that's going to go out, and so forth and so on. Well, the way to figure out how much the total possible supply of money will expand by is to take the money multiplier. Remember, I said that my reserve ratio was 20%. That's 0.2. So take that and plug that number in and solve for my money multiplier. Now, I can't divide by a number with a decimal in it, so I'm going to move that decimal over 2 places, and I'm going to do the same up top. I said 0.02. That should be 0.2. Sorry. Should be that. My bad. All right. 1 over 0.2 is 10 over 2, which is 5. That's a money multiplier of 5. Does everybody see how that happened? All right. Now, so the total possible expansion of the money supply is going to be 5,000. You put 1,000 in. They loaned out 800 of it, then they loaned out 640 of it, then they loaned out 80% of 640, and then 80% of that, and so forth and so on, until you maximize it out, and you can get as much as 5,000. In other words, 5 times that initial deposit of 1,000, right? So the money supply will increase by as much as $5,000. Okay, and that's what that is. The required reserve ratio is the percentage of total deposits a bank must hold as reserves, right? And what you would do is you'd take checkable deposits. The reserve ratio is going to be your ratio of your reserves to your checkable deposits. So if you have $1,000 in checkable deposits, then you're going to have to keep 200 in reserve, and 200 over 1,000 is or 2 over 10 in this case, really, is your required reserve ratio. Okay? And so that comes out to 20%, 0.2. That's where that comes from. All right? Hey, this was a nice, quick one, I think. Seemed like it. All right, so there's your nice review. If you need that, those slides are readily available to you on your course page. Don't forget to take care of the answer all the questions as best you can. And if you have any questions, don't hesitate to shoot me an email. I don't hear from many of you. That's okay. You're not under any obligation to email me. I hope the class is going well for you. Some of you, I just sent you an email. You need to figure something out. So otherwise, folks, have a wonderful day. Be safe. Be kind. Until next time, Econ Peeps.